Hey, everybody. It's your boy, Sean McLaughlin at Options Sean on the old Twitter X. Today is Thursday, March 5th, 2026. Hope you're doing well. If you have a lot of positions on like I do, well, your portfolio's not doing that well the last couple of days. Wow. You live by the sword, you die by the sword. That's the way momentum trading is. We've had some pullbacks to be expected, right? We came into this week with all the war headlines and all that, and you just kind of knew that it was not going to be the way it had been. Now, it doesn't mean doesn't mean everything's over. We got to throw in the towel. No, but we do have some risk management to do. We do have some stops that we need to update, some tight, get them tighter to lock in some well-earned profits before they get away from us. So without further ado, let's get right into it. Let's bring up the S&P, right, the chart right here. And when you look at the S&P, the SPY in particular, it doesn't look all that bad, right? I mean, we're still in that range we've been in now for, I don't know, 3 months, right? It still doesn't look that bad, but man, it feels bad. I mean, the ASO portfolio is taking a hit. My short-term portfolio is taking a hit. Man, high beta is getting rocked, sort of, right? Bring up the Qs. Qs kind of tell a similar story, still in a range, but inching lower. IWM, I mean, that's really probably the better indicator of where our losses are coming from because we're in some of the smaller cap names and some of the higher flyer names that make up the Russell 2000. So seeing what the Russell's doing makes a little bit more sense. Let's bring up the VIX real quick. For some reason, I can never type the dollar sign in this platform. Let's see that VIX. There we go. VIX is at its highest level of the year. Highest. We've been higher intraday, but if we were to close here, this would be the highest close for VIX for the year. So we'll see. We'll see where that goes. VIX is certainly in. It has my attention territory, right? This is when VIX is in the mid to high 20s. That's when you've got my attention. It's time to be mindful of our risks and be quick to take stops, and certainly don't let stops go. You want to stick to your plan. And when in doubt, stick to your plan. It's why we do plans at All Star Options. That's why every trade has a plan so that when the shit hits the fan and you're freaking out because you don't know what to do, just refer back to the plan. The plan has all the information you need. All right, so let's get into some some stocks that we've recently closed positions in, and we'll even talk about some that we may end up having to close tomorrow. In no particular order here, or I guess it is a particular order. It's the order in which we close them. Let's talk about Dokken, DigitalOcean, ticker DOCN. We were along a May 75 or May 55.75 bull call spread. We got into it back in January. It was going our way. It was looking good. Things were looking good. But last week we got stopped out on Friday. It closed below our level on Thursday. 55 was my updated stop. Got out the next day. But hey, curious thing. Curious thing. The stock, look, when we got into this trade, the stock was trading right around 53, 54 bucks, right? When I got out a month later, the stock was trading at the same level, 53, 54, same level. But look at this. I paid 515 to get in, and look what I paid, or look what I collected on the way out. 515. A scratch. That's pretty unusual, right? I was in a trade for a month. Stock was same price of where I got in, or I got out when the stock was at the same price of where I got in. A month later, you would have thought that theta decay, time decay, would have eroded some value in this position. Well, guess what? It didn't. And you know why? Well, theta did do its thing, but the difference is that on this date compared to this date, or so like last week versus a month ago, volatility was higher, volatility rised, and that contributed or offset the theta decay that we experienced in these options. It's not, that's not the plan going in for me. That wasn't what I was hoping for. I assumed I would be taking a loss, but to get out for a scratch, hey, feels like a win. Feels like a win. But we are out of DigitalOcean. Next up, Array. This was not the same story as DigitalOcean. We didn't get wrecked, but the stock got wrecked. We were along a bull call spread that we paid $1.50 for. Got into this back in mid to late January. We paid $1.50 for it. And coming out of earnings, Array Technologies got wrecked. The stock got wrecked. We were able to close our position for 48 cents, which, considering what happened to the stock, that's not terrible, right? We paid $1.50. We're out at 48 cents. I would have thought I would have been happy or lucky to get anything for that trade. Even if I got a nickel, I thought that would have been lucky. So the fact that I got 48 cents, probably because we have until July, a lot of time left, but not a terrible loss considering the earnings reaction that Array Technologies had. But we are now out of Array. And finally, Interactive Brokers. We got out of this one yesterday. This was a January 100 call calendar. And we closed it for 280 yesterday. We paid 310 to get in, got out for 280. Not terrible. By the way, I'm noticing that my when I'm looking at my screens, I'm like putting my hat down and you can't see my eyes. I apologize. I have a new setup here, guys. By the way, I got some new monitors, so I'm getting a new layout here, just trying to figure out the best ways. We'll get this dialed in, but maybe I shouldn't be wearing hats when we're when we're doing this. Anyway, Interactive Brokers were out at 280. We got saved by the fact that we had the short June calls that made up that call calendar, right? We were short the June calls, we were long the January calls, and the June calls lost a lot of money, which for us is good because, let me say that again. The June calls, the value of those June calls went down, which is great because we were short them, right? So the fact that the June calls made up a lot of the difference of, we made money in the short calls much more to the extent that we lost money in the January calls that we were long. Thankfully, or a big reason why is because those January calls, they have so much time to expiration. They have they have 9 to 10 months of expiration. So they're not losing a whole lot of theta decay, and they don't have a whole lot of delta and gamma thanks to the distance to expiration. So that's why those short June calls really offset the losses in the January calls. So it wasn't that big of a loss. We'll take it. That's why we do calendar spreads. All right. So those are the trades we exited this week. Bummers across the board, although I guess Dawkins felt like a win, even though we didn't make any money. But hey, them's the breaks. That's the kind of week we've had. Now, let's bring up, I want to talk about some open positions that looks like they're triggering exits today. I will exit them at tomorrow's open. PM is one of them. My stop level is 177, but as you can see, it's ripping through that today. Thankfully, we have a defined risk spread on, so we can't lose more than we paid. And more to the point, it's a March-September calendar spread. So those March calls that we were short, they've helped cushion the blow, certainly. In September, we have some time to expiration, so there will be some value retained in those calls. So it's not going to be a terrible loss, but nonetheless, looks pretty certain we'll be getting out of Philip Morris tomorrow. And there was one other. Oh yeah, well, this one, our stop was at 205. This one's a trade we only got into a couple weeks ago. It's been immediately going against us. I thought I bought on this red candle day. Thought I was getting a deal, right? Thought I was getting a gift of a pullback on an otherwise solid breakout. But the stock has other plans, and it is going down and is below our 205 stop loss level now. And barring a miraculous comeback in the last 30 minutes or so today and a gap higher open tomorrow, looks like we'll probably be getting out of this trade at the open tomorrow. So basically for me, the way I do it is if we're still below 205 at the open tomorrow in the first 30 minutes, I'll work my exit. I'll patiently work my exit to get out and salvage whatever I can in well. So those two trades, keep an eye on them. We will likely be getting out of those tomorrow. All right, let's update some stops. We have a couple important things to talk about in updating stops because we have a couple positions on that have March expiration. And I screwed myself up here. 1 second. I don't have my things in there, my tickers in there. Give me a sec. Let me look over here on this side of my screen. Okay, let's go through these in no particular order. KMI. I had the one in there. Okay. KMI, I'm raising my stop to 31. Okay, this one we have it's a big win. We got a lot of open profits in this one. I don't want to give too much of it back, so I'm raising my stop up to 31. Any trading back below 31 would invalidate this thesis, and hopefully we can escape that with a little bit of profit. But 31 is my new stop in KMI. All right, next one is Copart. We are short Copart via some long puts. We're long the May 37.50 puts. It looked like it was really going our way about a week and a half ago. I think this was an earnings reaction here on Feb 20, but it's bounced a little bit. You would think that with the market doing what it's been doing the last few days, that this would have followed suit, but it really isn't. It's being stubborn. So I'm lowering my stop down to 39 now. I don't want to see Copart get back above 39, which would roughly correspond with the high of earlier this week, as well as this sinking, excuse me, this sinking 50-day moving average. If it gets above 39, I'm done. I'm done. Copart, you're not doing your job. You're supposed to be going down and you're not going down. So I'll be getting out of Copart. Okay, now the next two are important because the next two have March expirations. And what I like to do when I get into March, when I get into the expiration month, I like to tighten up my stops dramatically. Now, mea culpa here, guys. Here's J&J. We have huge profits in this trade, right? Huge profits. It's down today. We've given back a bunch of profits. That sucks. But mea culpa here. I have to admit, I was asleep at the switch on this one. When I get to, the first of the month, so in this case, it would have been Monday of this week. My best practice is I will go through all my charts or all my positions that have options that expire this coming month, and I will, at that point, aggressively raise my stop. Had I done that in J&J, I did not do that in J&J. Somehow it just slipped my mind. I don't know. Maybe I was lulled to sleep by the fact that it was just doing so well. I had my eye on this 260 level. I was waiting for this thing to get to 260 a few days ago, and the stock was trading at 251. I was like, all right, 260, here we come. That's my profit target. Well, I fell asleep with the switch and I didn't realize that, once I get to the first, that's when I start trailing a stop. And I like to trail my stop somewhere like in the neighborhood of a 3 to 5 day low. I use a little discretion. I'm basically looking at charts, seeing where there's a significant low in the last 3 to 5 days. Had I done that at any point before today, I would have put that stop at right about 242. Yeah, probably 242 would have been my stop. And if that being the case, today at the open, I would have closed it and taken my profits, whatever they were, less than they were a couple days ago, but still robust profits. But I didn't do that. And I don't have an excuse for it other than I just fell asleep at the switch, at the wheel. So that said, I am now watching J&J. I'm still in it. I haven't done anything. I'm liking the way it's kind of bounced this most of this day. So I now have a stop in at 237. If it comes back below 237 intraday today or at any point over the next few trading days, I will close the trade at that point. I'm not going to wait for a closing price and then close at the open the next day. Any intraday violation of 237 from here, that's as far as I'm willing to let Johnson Johnson go. So I'll be getting out of the trade. If you want to get out of the trade here, I have no problem with that. In fact, great idea. Go ahead and do that. Right. But for me, we have a lot of profits in this trade, so I'm okay with that. I'm okay with that. 237 is my stop. But in the next few days, as we get closer and closer to expiration, I'm going to look to raise that stop. If I'm still in it, if I don't get stopped out at 237, and if J&J bounces from here, I'll be looking for opportunities to raise that stop. Okay. The next one I want to bring up is EZPW. Similar situation, long March calls. We're sitting on a very large winner here, doing great. We've already sold half, so this situation is a little bit different. We've already locked in some profits in this trade, some handsome profits, right? We bought these calls for 75 cents. We already sold half of our position for 510. So what's that? I don't know, 7x our money on half of the position. The stock has gone up since then, but now 25.50 is my new stop at Easy Corp, and it's getting close. It's close there right now. So we may stop out of this one today, intraday. So something to keep an eye on. But 25.50 is my stop in Easy Corp. And just like Johnson & Johnson, I will look to raise that if Easy Corp bounces from here. But either way, we got some locked in profits. We are doing just fine here in Easy Corp. All right, so those are the updated stops. Let me just bring this slide up here for you. If you guys want to take a screenshot of that, you can. I got the highlighted ones, J&J and EZPW, because those are highlighted because they are March expirations. So we want to be aggressive with those stops. But those are the updated stops in the portfolio for now. Let's get into the new trades we've put on since we last spoke. We've got 3 new trades, a mixed bag of trades, really. I'm not going to get too much into the details of these trades. The details can be found at allstarcharts.com. Head to the members section, head to the options section. You will find detailed trade plans for every trade that we put on. If you're not a member of All Star Options, get involved. We put great trade plans out. We're having a great year. People are making money, and we have a great community. Love to have you involved. But anyway, the trades we put on, we put a bearish trade on JP Morgan. So far, today's doing pretty good, but we got into this trade a few days ago. I think we got into it last Friday. It's been a kind of a mixed bag, but I put JP Morgan on more than anything as a hedge. I wasn't incredibly bearish on JP Morgan, although I was bearish when it was breaking below 292. That's kind of what caught my attention. But really, for me, it's a hedge. It's a type of trade that if the market's gonna, if we're gonna see continued downside in the broader markets from here, JP Morgan and big banks like that are likely to come down as well. So that's why I put this trade on. It's a bearish bet. Again, all the details can be found at allstarcharts.com. Next trade we put a bullish bet on in MPC. This was we got into a few days ago. So far, so good, but today's red candle sucks. But we almost got to our profit target. We had 230 is our profit target in this trade. Again, details of what this exact trade is can be found at allstarcharts.com. It's not just a simple call trade. We're doing a spread of a variety, of a flavor. 230 is our profit target. Almost got there today. Wow, that would have been something. But it is a bullish bet in Marathon Petroleum. Hopefully today's candle can pause and reverse from here. And then finally, Apple, we put a delta neutral trade on in April. In Apple, we have a few weeks. My bet is Apple's going to go sideways. Maybe not necessarily exactly sideways, but I think it's going to stay within these ranges I have highlighted here. I think it's going to stay below the all-time highs of 290, and it's going to stay above the 240 level, at least for the next few weeks. That's all I needed to do for me to hit my profit target in my delta neutral trade in Apple. So mixed bag this week of new trades. We got a bullish trade on, we got a bearish trade on, and we got a neutral trade on. How about that? When the markets are moving and changing, we have to adapt, and that's what we do here at All Star Options. Whew. All right. Sorry, I haven't been checking the chat here. Let's see if there's any questions in here. Lynn's another day, a few less dollars. Yeah, I feel you. I feel you, man. These last 3 days have been tough all around. Who doesn't like volatility? Yeah, Jay. We like volatility generally. Let's see. Good afternoon from Lakeland. Hi, Lakeland. And Richard, would there be more gaps to the market because of all the volatility? There could be. There could be, as VIX keeps rising. If it continues to rise, we could see gaps in both directions, both higher gaps and lower gaps. We should expect to see that. Yeah. All right, folks. That's all I got for you. If you have any questions at all, you hit that email there at the bottom, info@allstarcharts.com. That'll get routed to me. I'll be happy to answer any questions you have about any of the trades we have on in All Star Options or anything about the All Star Options service. I'm at your service to talk about the All Star Options service. If you'd like to subscribe, the link's there at the top. Link is also at the top of the chat. I also have a free options newsletter. And hey, this is a great week if you're not already involved in my free options newsletter. I don't write every day, but I write many days. And this week, I'm doing a deep dive on some lessons I learned from rereading Trading in the Zone by Mark Douglas. If you guys haven't read Trading in the Zone by Mark Douglas, what are you even doing? That's one of those books that should be required reading whenever you open a new brokerage account. They should send you that book. like as a gift. Like, hey, please read this book before you place your first trade. It's a classic. It's been around a long time. I've had it on my bookshelf for many years. I've read it and reread it many times, but I picked it up again this week for the first time in probably a few years. And we're talking about the 5 fundamental truths of trading that Mark Douglas talks about in this book. And we're getting into that in the newsletter, doing a deep dive on that stuff. So, hey, why don't you subscribe, be a part of what's happening, and hopefully you learn something. I'm learning something just by writing about it. All right, folks, that's all I got for you. Have a great rest of your trading week. Hang in there. It's still a bull market until proven otherwise. We'll see what happens. All right, folks, see you next week. Take care.